Welcome to Insider Events Finance Meets Its Future, presented by Amberdata. Here's our host, Senior Finance Editor at Insider, Dan DiFrancesco.
Hi, I'm your host, Dan DiFrancesco, Senior Finance Editor here at Insider. Welcome to Finance Meets Its Future, presented by Amberdata. It's an unprecedented time in the finance industry, whether it's the downfall of Silicon Valley Bank or UBS's rescue takeover of Credit Suisse. All eyes have been on Wall Street in recent weeks. And still, making sense of the digital transformation in finance, digital assets, frictionless payments, and sustainable investing matters now more than ever. Today, you'll hear from institutional finance executives, fintech leaders, and bank leaders about the innovation taking place across Wall Street, from enabling payments to the ever-growing world of digital assets. During our panels today, my colleagues will ask some of the most burning questions the industry is facing, such as, what's the state of digital transformation and modernization on Wall Street? How do you see digital assets and their markets fitting into the context of the overall financial system? How should your choice of financial partners shape how you think about payments innovation? And what are the biggest catalysts from an ESG investment perspective? We'd love for you to be a part of the conversation, so please share your thoughts on social media by using the hashtag InsiderEvents. And you can ask our panelists questions by using the dashboard at the bottom of your screen. We'd love your feedback. And now, I'm delighted to introduce our first session, Demystifying Digital Transformation in Finance, a panel discussion led by Insider's senior finance reporter, Bianca Chan. Over to you, Bianca.
Thanks, Dan. Feels like 2023 could be a really big year for tech on Wall Street. Most banks are in the middle of their cloud migrations, opening up a whole new way to think about tech development and maintenance. Banks, more than ever before, are setting themselves up to partner with fintechs. There's a proliferation of data, and with the cloud and AI, there are now tools to analyze data at a depth and scope maybe some thought impossible 10 years ago. And of course, banks are making progress culturally, borrowing strategies from startups and big tech companies alike to execute on tech initiatives faster than ever before. I'm thrilled to be here with two of the brightest tech leaders on Wall Street. We have Peter Akwaboah, the Chief Operating Officer for Technology and Global Head of Innovation at Morgan Stanley. Also, Ritika Grewal, Head of Digital for Commercial Banking and Corporate and Investment Banking within Wells Fargo's Strategy, Digital, and Innovation Group. Welcome to both of you. I want to jump right into it. I'd love your take on what is the state of digital transformation and IT modernization on Wall Street. Let's start with you, Ritika.
Yeah, we at Wells Fargo are really focused on bringing digital-first, customer-centric solutions to market across the spectrum, from our consumer side all the way through to the corporate and investment banking side. One great example of what we're doing and sort of like a different way that we're approaching it is we just recently launched at the end of last year a brand new portal experience for our clients in the corporate and investment bank as well as the commercial bank called Wells Fargo Vantage. And that work was done sort of with that digital first mindset, making sure we're putting the clients at the center of everything that we're doing, thinking about how they run their business from a day-to-day perspective and the problems they're trying to solve and how we can bring the right tools to bear for them. And then, with this new transformation and this new way of working, the way that we've built this platform from the ground up is with a layer of machine learning and artificial intelligence from the very beginning, right? Like a lot of places are trying to add those things on, but this is sort of the base that's going to drive the personalized experiences that we know our clients want. We've had some progress on the consumer side, and as our clients are demanding more consumer-like experiences, even as they're interacting on their business side, it's really important to think about that personalization element and how you can bring all of your tools to bear. But that platform really helps to demonstrate a different way that we're really approaching the modernization that we need to do and thinking about things like the cloud that you talked about early on, and how do we leverage the cloud to bring things to our clients faster, better, and also thinking about fintech partnerships to do the same. So Vantage is really a nice way to think about how we're pulling all those levers that you talked about at the beginning in your intro and really trying to drive a great client experience from that.
Thank you. Yes, and I'm sure we're going to dig into a lot of that later on in the conversation. But Peter, what does digital transformation mean to you? What is the state of it at Morgan Stanley and on Wall Street more broadly?
So thank you so much. Thanks for the invite here. It is the appropriate time to have a discussion like this. So for us, as you know, in Morgan Stanley, we have largely three main businesses that makes up. If you look at the revenues last year, 54 billion. So we have obviously the institutional securities business, which is a traditional risk management business and supporting corporate clients. And we have their wealth management business and also our asset management or investment management business, which makes up the 54 billion. And I think I would say that when we think about the state of our digital transformation, I break it down to three parts. One is really around what we're doing from an innovation point of view that supports our digital transformation from a customer's point of view, as well as an employee experience point of view. You would note one example that we just made an announcement around our partnership with OpenAI. Part of that is really thinking about how we provide the right level of flexibility to our clients by leveraging some of the new powers of generative AI and so forth. And so this all theme around innovation is something we focus our attention on, but it's really broken down into the customer journey as well as the employee experience as well. You will notice that we've acquired E-Trade. That was partly to complement our business model as well as eating buns. And so we see some of these innovative ways of doing things is not necessarily always generating things organically, but where it makes sense to complement our business model, we will do that as well. So that's the first category. The second category, which one can never avoid, is being effective in the organization. And when you look at where the industry is going, it's not just about focusing on the customer journey and so forth, but we also have to provide an effective way of doing that. So we spend a lot of time around looking at our own internal processes and making sure that we continue to digitize those and make that as effective as we can relative to how we support the customer, because that we believe that is also important. As the customer comes through the front end, we have to make sure that the back end is also as efficient as possible as well. So it's an effectiveness conversation that we spend a lot of time on. And then the third thing, which I think is very important as well, is the safety and soundness of supporting these the franchise, which I call the resilient part of our franchise. So we spend a lot of time around investing into our basic infrastructure around cyber. These days, cloud has become table stakes in the way we do things and making sure that we leverage that going forward. Spend a lot of time around our fraud capabilities, but it's all around making sure that we have a safe, sound environment, and also our infrastructure is within the right zip code to be able to continue to support our the 54 billion franchise that really ultimately supports the customers.
Thank you. Yes, tons to dig into there. Obviously, digital transformation, multifaceted, and a world of opportunity, really. But you know, it's not always smooth sailing to get there. What has been the hardest part or the hardest thing about driving digital transformation within banks, and why? Peter, why don't you continue?
Look, I think the first thing I would say is really the multiple competing priorities. And I think everybody will have the same conversation when we talk about some of the hardest challenge. We're competing or we're trying to solve the regulatory agenda, which I will argue in some cases they are healthy to be able to complement our business model. But nevertheless, we have to think about how the landscape of the regulatory environment is changing. We also have to think about our own, what I call the technical debt, which is we build, obviously, our infrastructure for a period of time. We have to continue to evolve that relative to some of the new ideas coming up. And so making sure that technical debt continues to be modernizing going forward is an important part. Now we have the cloud. We are not necessarily just basically shifting things onto the cloud. We're being thoughtful around making sure that we can modernize our applications before we move to the cloud. So we have this kind of multiple competing agendas on the table. The more you digitize, the more you also see the scale of our safeness and soundness becoming more important. So the investment in the cyber becomes something that we have to compete. So we're growing our business. We're having to make sure that we're doing it in such a way that it continues to be regulatory compliant, as well as making sure that it becomes very safe as well. So these are some of the things that is making it tougher for the market. But the way we offset that is really having a true partnership ecosystem on an end-to-end basis. So we have a good way of partnering and working with the business and really driving business outcomes. But we've extended that to real partners with our fintech and our strategic partners in the ecosystem. So you will see that, as I said, we had an announcement recently with OpenAI. We've also had an announcement with Microsoft as an example. These are partners that we're working with because we believe that the ecosystem has to drive it on an end-to-end basis if we're to tackle some of the challenges that we see.
Mm-hmm. Yes, and Ratika, what would you like to add to that, if anything?
Yeah, I mean, I think that like when you're talking about true digital transformation, I like one thing, the sort of framework that we like to think about as well is people, process, systems, right? And so like I think Peter, you kind of touched on those in sort of your description, but right, like when you're changing things, dramatically, or even beyond just a presentation layer, you just have to make sure that you're tackling the change that needs to be driven all the way through, how people operate, where their focus is. Like I think you kind of touched on that a little bit, Peter, in reference to some of the changes that you guys are driving, the processes, like what are the underlying processes when we're working in like a really big complex institution like we are. How do we make sure that we've got everything sort of ticked and tied? And then the systems, right? Like where are we putting things? How are we putting them there? How are we calling them, right? Like data is a really, really big component of any digital transformation, and making sure that we've got that sort of thought through as well from that people, process, systems lens as well. So that's a little bit about how we think about, what it means to transform it these days.
Mm-hmm. Yeah, and I feel, a lot of the times the conversation around digital transformation can be so big, and I want, our audience to be able to take away some actionable tips. So I know it might be difficult, but can you boil down, what has been the single most important change that you've made, or that has had the biggest impact to your ability to modernize and digitize and, operate with a digital first mindset? Peter, please.
This is a very interesting question because the single most important change. I wouldn't say that there's kind of one thing that we think about. I would say that the biggest thing we focus on is culture, because things change in a dynamic way, and you have to be able to be nimble and agile to be able to reflect to those kind of changing environments. So what we focus our attention on is really making sure that there is a culture of change, culture of innovation. And when you think about that, is really around how you partner and really think about the business outcomes. What are you actually solving for? And making sure there is a ruthless way of aligning the resources on an end-to-end basis to solve for that. And I would say those are the things which have helped us when you think about the pandemic. Nobody can predict that actually we will end up being in a way where we have to provision half of the people working from home. I don't think none of them was in any blueprint, right? It was not any blueprint that we have to provision everybody to work from home. We have to support 3 or 4 times fourfold the volumes and make sure that we continue to remain resilient. So the way I think about it is really having a ruthless culture coupled with the way we organize ourselves, which is an agile approach. And that agile approach breaks things into specific areas where you can really partner on an end-to-end basis. You can define your KPIs and your outcomes, and you prioritize in the right way to be able to get that things done. And I would say once you do that, you are able to adjust to anything that is coming to you, because you have to be nimble and dynamic to be able to service those outcomes.
Ratika, I see you nodding, and I know from previous conversations, this is right in your
Yeah.
wheelhouse. Tell us more about
Yeah.
how Wells Fargo approaches this.
Yeah, no, I mean, I think that there's some big similarities, I think, in terms of how we approach it. But I would say, just sort of back to your original question, like one of the most important things we did when we're starting on this transformation journey was, that like in making sure that everybody from a cultural perspective had that deep passion for our clients. And so we set out on building out a library of personas. So ranging from a really, really small client to a really, really complex client, and with sort of an acknowledgement of the different kinds of people within any given company that would be potentially interacting with our digital tools. And the thing that I love so much about the commercial banking and the corporate and investment banking space is our clients are so dynamic. So these personas help to give you a snapshot, but then just like following along and making sure that we're continuing to build things in a way that helps grow the way our clients grow. And so like that's really like the unification around like who's the client, what problems are we solving, like that personas work was really galvanizing, I think, for the team. And we've got these people that we all like know affectionately, ambitious Amy, efficiency Ella, right? Like, so we can always at any given point say like, who are we solving for, and what problem are we solving? Like that, I think for us was probably one of the big first steps that we needed in this journey for transformation on like the Vantage portal, for example.
Mm-hmm. No, that's super interesting. I wonder which character I fall into.
Yeah.
Peter, zooming out with a more macro lens, how are you setting Morgan Stanley up to be ready for the future of finance? How do you ensure your modernization efforts kind of reflect the future makeup and direction of the industry?
Look, I think you see that once a year we always signal what our strategic intention is. So you will see when James, our CEO, and our CFO Sharon goes through the results. Once a year, we always signal what is our strategic intention and where we're heading. And that is important because I see that as something that we always make sure that within the organization that is cascaded through the organization. And that is an important part of everybody being behind the strategy and how we're servicing our customers. Beyond that, I think it becomes more around what I talked about, which is being very clear around the things that we've put in place and making sure it's sustainable going forward, and what we're doing around the agile framework we put in place, making sure the business outcomes is clear. I think those are the things that I believe we've put in place, and we will continue to make sure that that's robust and sustainable going forward. The other things that we've done, which I do think will help us move things forward, is that we have a unique advantage that once a year we bring some of the top 100, top 150 of our business and technology guys together for a week, where we spend a week in most cases the West Coast. We've been doing the West Coast. We may think about different locations, but we basically take a step back, spend time with our vendors, our business, our technology partners, our new startups, and really focus on how are we doing, what advice can you give for us, where's the product going, and what are the new things which are coming out that can complement our business model as well. So you see that there's a shift between what we used to traditionally build to now what are the areas that we have to buy going forward, and how do we complement our whole ecosystem on an end-to-end basis. And the last thing you can see is that for us to move forward, the firm has recognized that we have to have somebody who runs innovation. So my job is the first of its kind within Morgan Stanley, but part of that is really making sure that we continue to integrate the firm on a one-to-one basis and continue to think about what Morgan Stanley and what are we learning from the wealth management business that we can actually build within the institutional securities business as well. So I remain quite positive in this space, and the way we set ourselves, I think it makes us more sustainable going forward.
Mm-hmm. May I suggest Seattle for your next trip out west coast?
That would be excellent, given the fact that some of our partners are based there.
Well, I'm happy you brought up partnering and versus buying versus building in-house. Ratika, I know that at Wells you guys have done a great job at setting yourselves up to be able to easily partner with fintechs. Tell me more about your embedded finance and your API initiatives.
Yeah, no, we're doing a lot of work in that space. I mean, Wells Fargo was one of the first banks out there with our big API platform, and we've got a consistent record of continuing to add onto that platform. And so, now the embedded finance space is a way that you really try to bring more of what we offer to the tools and the systems that our clients are using. So just going back to a couple steps backwards to go forward, right? Like Peter was talking about, like the client listening that we're doing. And so some of it is, direct listening with our clients and saying, okay, so what are you doing today? And like listening, but a lot of it is just observing, because sometimes they're not able to actually articulate some of the workarounds that they've put in place to deal with something. And so like embedded finance is like one of those watching what they're doing, which is different than what they're saying use cases, right? Like all the different systems and tools that a company may use in order to run their business. Like, how do we integrate all of those things together, leveraging this great API platform that we've got in order to get a little closer to the customer, again, solve their pain points. And so in doing that, we've kind of opened up sort of the ecosystem a little bit to think about the types of partners that we could use to help deliver things in a faster or more integrated way, right? Like we're never going to learn every single ERP system, the ins and outs of it. So where can a partner be helpful to us? Or where can a partner help to bring some data that could be useful in serving our clients better and things like that. So, there's a variety of different ways. Within our main portal, we've got some partnerships in place to help deliver sort of unique experiences to our clients where it makes sense for them to be able to do that from a speed to market perspective and from a long-term skill set perspective. And then also same thing on the API side. So how do we leverage that ecosystem the right way to deliver great things for our clients? And like you were saying earlier, our employees as well is something that we're thinking about.
Mm-hmm. I mean, I could chat with you guys for hours on this. I'll wrap up at some point. But it's really interesting to kind of hear how you're both approaching digital transformation, what it means to you, how it plays into the future of both of your banks. I love how it seems equally outward facing as it is inward facing. It's kind of both sides of the coin. So it'll be interesting to see how this plays out. I want to thank you both, Ritika and Peter, for being here today. And back to you, Dan.
Thanks, Bianca, and thank you so much, Ritika and Peter. 2023 is definitely shaping up to be a big year for tech on Wall Street. Don't forget, share your responses on social media with the hashtag #InsiderEvents. Up next, we're picking up the conversation around access and the mass adoption of digital assets. Please welcome Insider Investing correspondent Layla Maiden and her guests for a discussion around digital assets related to blockchain technology, including cryptocurrencies, NFTs, and the tokenization of real-world assets.
Thanks, Dan. I'm here with my guests to take a closer look at how access and the mass adoption of digital assets and blockchain technology as a whole will impact financial markets. I'm thrilled to be here with three leaders in the space: Sean Douglas, CEO and co-founder of Amberdata; Caitlin Long, CEO of Custodia Bank; and Guy Hirsch, Managing Director for the United States of Kraken. Let's get into the first question. How do you guys see digital assets and their markets fitting into the context of the overall financial system and Wall Street? For example, will crypto and NFTs be an additional asset class added as a category amongst stocks and bonds? Or will blockchain technology power the entire financial system, meaning even real-world assets will become tokenized? Guy, I'd love to hear from you first.
Sure, absolutely. So I think that initially crypto was adopted by those who believe in the ideology of freedom, liberty. They were driven by some sort of a noble cause. Then we had the influx of speculators that drove crypto and Bitcoin primarily into the $19,000 around 2017, end of 2017. And now I think with NFTs, we have a chance to bring about additional influx of people because of affinity to brands, affinity to sport, affinity to celebrities, and so on and so forth. And the tokenization of everything, I believe, would bring about a democratization of building a portfolio that was privy only to high net worth individuals up until now. So for example, if you're really, really wealthy, you probably have some allocation to art, some allocation to real estate, some allocation to stock, bonds, things of that nature. The average investor can't do it. With tokenization of everything, they will be able in a few years to build a portfolio that has some allocation to real estate, some allocation to art, some allocation to other assets, and build a more diversified portfolio and build their wealth that way. So I think we're definitely heading in that direction.
I'm really excited for a world that looks like that. Sean, I want to hear your thoughts on this one.
Yeah, absolutely. So, I think digital assets is really the financialization of the internet, and whether it be taking real world assets on chain or digital rights management, all NFTs, or just making today fairly opaque, exclusive markets to trade in public markets radically transparent and global and accessible to all. That's really what I think the mission of digital assets is undertaking. And it's a massive transformation that's bigger than anything I've ever seen.
Caitlin, do you have something you want to add to this one?
Yes, I think the real utility is in the payments world. And so your question, it's not an either or, because of course the technology can power payments in the traditional system, although the way the US is going, they're pushing away from the use of open permissionless protocols towards closed sort of corpo protocols that are not as powerful. And frankly, at the end of the day, people will vote with their feet. You can right now download, say, the Lightning Network code and move any fiat currency in the world using Lightning as an intermediary currency. You can go dollar to dollar, you can go dollar to yen through Lightning, and 8 billion people can download that code and use it. It's still small right now, but nobody needs permission to run that code. And so the world's going to change pretty radically as adoption rates start to increase and people literally vote with their feet.
Well, speaking about technology always leading the way, we know that historically, but also about permissionless systems. DeFi is a big one on that. Let's talk about DeFi, decentralized finance. Will it become the future of finance? If so, how do you see institutions embracing it? Sean, I'm going to throw it over to you for this one.
Yeah, so I really do believe that DeFi is the future of finance. If you think about fintech, that was really factoring payments out of banking. And as Caitlin talked about, payments is the use case today. But if you actually think about all financial services being factored out into elemental components that can be put together into new financial services, the total addressable market for that being every person and every business on the planet, this is going to happen. And it's super powerful for financial institutions, because rather than paying AWS to develop their product and paying to run that, they're able to run that on a public open network where their customers pay the transactions. It massively is more efficient, and it creates global innovation. I 100% agree that DeFi is the driving force behind digital assets.
Guy, what do you think about the DeFi sector and all that it can offer the financial systems?
I wholeheartedly agree. I think DeFi is indeed the future. It allows us to do things we haven't even imagined about before. However, I would say that on the edges of DeFi, at least for the next, decade or two, we would always find some sort of a centralized entity providing some sort of a bridge between the old world and the new world. And we also understand that when something is permissionless, when something is truly decentralized, the reach of regulators, the reach of the state is basically non-existent, or is basically mitigated. And I think there will be a continued battle between that and between DeFi. So we would have to work really diligently with state actors, with regulators, to still allow this innovation to flourish, not to be afraid of it, but embrace it, because it will better society. But still, we will need to, as an industry, to provide a lot of education as to why this is better for all.
Caitlin, I know you have some thoughts on this, especially following up with what Guy just said. I'd love to hear your thoughts.
Well, if you look at the way the internet evolved, really every market has lit and dark versions, right? So most of us use browsers and an internet service provider to use the internet, but if you're technologically savvy, you can just use Tor. And so there are alternatives. And most people, of course, migrate because of the user experience, the brand recognition, the security, or at least the perception of security, because they don't have confidence in their own security skills to use Tor. They'll use the sort of lit markets. That same thing is true with phones, right? Most of us use, in the US, Verizon, AT&T, or T-Mobile. We don't use the command line interface, even though we could, to make a phone call using voice over internet protocol. So I think the analogy here is that in the financial world, that the incentive is that people will migrate towards the more trusted, more regulated players. However, just like in the browser space, Tor exists. You don't need to go through a centralized point like that. So that creates the really nice incentive for the centralized players not to overreach. And boy, have we seen overreach from centralized players. Look at the cancel culture happening, for example, in big tech. So what's fascinating about it is The regulators in the US right now are going in exactly the opposite direction. They're trying to push everything into the dark markets in the US and push it, frankly, offshore. The great irony is that FTX set up offshore precisely because Sam Bankman-Fried never could have complied with the requirements to even become a money transmitter onshore in the US. And so we're just going to continue to get more and more of those, I fear.
So I think you just led us into my next question. And like with any innovation, there are always obstacles to adoption. What do you foresee as being the biggest obstacle to institutional adoption of digital assets? Caitlin, let's start with you on this one.
Well, right now, the regulators in the Biden administration are sure trying to kill it. There is clearly a coordinated, multifaceted, multi-agency attack in the United States. And it's so interesting because what I see globally, for example, Hong Kong is starting to open up again after a couple of years of China banning it. And we just saw, for example, Russia this morning opening up. So the US is on such a different cycle with the rest of the world. And those who are onshore in the US tend to be very American centric, but we need to recognize this technology knows no borders, and that's one of the powerful features of it.
Well, I think what happened with FTX kind of caused a shock to the system, and regulators are sort of scrambling to figure out how they can address this. Sean, I'd love to hear from you about obstacles facing the mass adoption of these digital assets for institutional investors.
Yeah, so I think first, Caitlin made a great point is that the rest of the world has woken up and if you look at London, Singapore, Dubai, they're epicenters right now that are massively growing. Digital assets are building there. The smartest institutions are setting up entities there and they're embracing this because they see it, the writing on the wall. And another thing Caitlin said is it's about incentives. Incentives drive behavior, and many of our regulators are acting with effectively protectionary political postures that are not necessarily serving the general populace, but maybe their constituents that pay their bills. So I think that there's the regulatory backdrop, but it's interesting is that if you trade on any public stock market or derivatives exchange or what have you, you actually have very little transparency into what is the global liquidity, what is market depth, why did I get this fill, how did I get arbed, what's happening in a dark pool, who's paying for my order flow. However, just opposed to digital assets and crypto, where you can actually see a global market trading off of tens of exchanges around the world in different jurisdictions, coming to around the same price, as well as on-chain activity showing who held what when at what price, and then the mechanisms, which are effectively fundamentals that are driving the valuation of these assets. I think institutions who are leaning in, whether it be banks creating non-forward deliverables, which are effectively futures because they're afraid to actually hold the asset, or creating structured products, or whether it be trading firms looking to participate and provide liquidity in this massively growing market, or then the whole supporting ecosystem around financial services. At the end of the day, the data is there, and people like us have built massive businesses around providing data so that institutions can adopt. And whether the market is going up, you want data, or if the market is going down, you need data. I think that the data is richer and more robust than in traditional financial services. So eventually people will come around, the regulators and what have you, and realize that this is actually a blessing for them, that they should just get out of the way of innovation.
Well, the whole idea of blockchain technology is that it does create transparency in real time. Guy, do you have something to add to this in terms of some obstacles in the way of this innovation?
Yeah, even though I agree with Caitlin that we see a lot of adverse actions, there are still, I think, a lot of hope. There's still a lot of hope. For example, the Financial Stability Board is adding interpretation so that corporate treasuries can add crypto onto their balance sheets and marking them based on a fair market value. That would allow a lot of corporate treasuries out there to allocate to crypto in order to manage their cash and cash equivalent in a more effective way. You have now the SEC proposing a rule on how to define qualified custodians for crypto specifically, with a particular focus on crypto. And I think once that will be resolved in a successful way, then more registered investment advisors would feel comfortable allocate to crypto. So I think there's a lot of obviously adverse reaction out there, no doubt. We have to do what we need to do as an industry to make that better. But still, there's a lot of hope. There's a lot of good things coming in terms of clarity that would allow institutional investors to allocate to crypto and really grow the industry.
Speaking of the positive side of it, that's what I want to jump to next is, what are some of the biggest benefits or positive contributions that digital assets offer society and the financial system? In light of all the crazy negative headlines that we're seeing, there's a lot of positive to this technology. So I want to hear it. Sean, what are your thoughts on this?
Yeah, so I think that one of the biggest advantages is one, radical transparency. So if you look at all of the failures in the 7 large failures that happened, I don't need to name them all, everybody knows what they are, in the last 6 months, all of them were counterparty risk or opaque, complex, layered entities that nobody really knew what they were doing. It's a recreation of the financial crisis. And ironically, we're this week seeing multiple banks blowing up, and you see the entire banking and financial services industry down 10 to 20 something percent, with other banks down 70%, and they're being seized by FDIC. Like, are we back in 2009 again? So I really think that the advantage that DeFi and digital assets brings to the table is, despite all that bad stuff that happened in the last 7 months, DeFi worked as planned. There was radical transparency. The health of those DeFi protocols like Aave, I think, is a really good example, where they cleaned up the risk in the system. People were incentivized to clean up risk. People were incentivized to participate. It worked as expected. And the transparency is what facilitates the people to participate and trust it. Where today, pick the bank that blew up today or yesterday. If you're a customer, you had no visibility into what their balance sheet was. Like, give me a break. That we literally are in 2009. So I think that the most positive contribution is this radical transparency and the ability to be not locked into somebody else's proprietary closed garden where you have no control and the regulators are protecting your interest and they have no control either. All they can do is come back and give a speeding ticket later. I think this is a better path forward. And then if you look at NFTs as the future of digital rights management, imagine being able to, if you're Disney, to own into, or if you're a creator, to own the asset that previously you had no control once it left your hands, and own an annuity stream. There's going to be massive businesses in art, in music, in loyalty points, in whatever, built around this that are going to change the world in 20 years in a way that we can't even envision today.
Caitlin, I know you probably have something to add to this.
Yeah, I just fairly recently heard a story about somebody who had a short-term opportunity offshore. This was an American company and needed to move US dollars really quickly to take advantage of that short-term opportunity. And they did it through stablecoins. And it created a real value that was fleeting. If they had had to try to go through the US dollar system, through SWIFT, bank to bank, central bank to central bank, there would have been 6 hops on the transaction. But through stablecoins, they were able to move the money within minutes, and it literally within a morning had multiple transactions just completely done, and the US dollar cash in their bank account. That's a real world business application of this, and it just goes to show you people with their feet to use these technologies, even if the regulators are preventing them from doing so. They would much rather, however, be able to go through these trusted on and off ramps than to deal with sort of the Wild West. But as we saw in the U.S. with Uber, people voted with their feet to use Uber because the experience was so much better than the experience of using the taxi and limousine commissions medallion taxis. And that's what's going to happen here in payments as well. These solve real world problems for real businesses.
I hear you on that. I think it's been quite a while since I've taken a cab, and I live in New York City. Guy, really quick, I'd love to hear what are your thoughts on positive contributions of this technology to society?
So at the core of it, I really do believe in what the cypherpunks initially kind of promoted, which is we have the right to transact, we have the right for privacy, we have the right for our own property. These are basic rights, and as manifested on the web, it now that we have a native digital currency, now that we have native financial applications on the web in a decentralized way, we can accomplish those goals in a way that wasn't available before. So if you are a creator in Africa and you suddenly realize that you can create digital art and gain access to the global economy and earn a living by selling your art in a way that wasn't accessible before, and earn royalties as your art is being sold and sold again, that is amazing, because you no longer need to migrate and physically risk your life to move to New York or to move to some other financial hub. You can stay where you are and still earn a living. Or just another example, if you're a farmer and you want access to insurance against flooding and things of that nature. Before crypto, you didn't have access because it wasn't financially viable. And now suddenly, through decentralized protocols, you can opt in to an insurance that would pay you something if some oracle is feeding into the smart contract that there has been a flood where you are, and pay you whatever you need to get in order to continue on living. So that is amazing, real world applications, and at the heart of it, freedom.
That is incredible, Guy. Thank you for sharing, especially the story of the artists and that potential with us. Now, we've reached our final question here, and that is, what is your prediction for the future of digital assets? Sean, I'd love to start with you on this one. Where do you think we're going to be?
I think you got to take a long view, and if you look forward, like if you think about the creation of the internet, like it was the beginning, like everybody needs a website. You're going to be the brick and mortar, or you're going to be an internet-based business. If you fast forward today, everybody's an internet business. I think digital assets and DeFi and all of this will expand into, it will become invisible. It will be part of your fabric of daily life. You will have less dependencies on central banks, any bank, other than people who are participating in the digital asset space, who are helping facilitate and transact in this. But those that are putting up walled gardens and trying to exclude crypto will become irrelevant. And I think that this will enable a massive creation of value for people around the world, and those that embrace it will benefit significantly, and those that don't will be irrelevant in the future.
Like the fourth industrial revolution. Guy, what are your predictions?
I think once we realized with the Satoshi Nakamoto white paper that code can equal money for the first time, then you really unlocked a wave that cannot be stopped. Because once programmers and coders can code financial applications and can code money and can code value, it's, to me, there's no way this is stopping. I'm very bullish on the future. Yes, we have a lot of hurdles. Yes, we have a lot of things we need to do in order to be successful here, but there's no way this is stopping.
Caitlin, closing thoughts on this. Where do you think, what's the prediction from your end?
Oh, well said from the co-panelists here. This is inevitable, and 8 billion people can download the code and run it. There is no stopping that. And most of those 8 billion people have phones, and the engineers are just making it easier and easier for users to interface. And I'll close by saying that the regulators who are trying to stop this, they tried it. They try it every 4 years during the Bitcoin bear markets. And in the last one, guess what? The engineers created Tether, and Tether was created essentially, as they say, invention is the mother of necessity, or as the old saying goes. And essentially, that's what happened here. And I can't wait to see what the engineers do, because literally, once the banking system was shoving folks out of the access to the traditional system, not only did it prove why these technologies are so interesting to people, but it also, the regulators got in the decision that they made out of fear exactly what they feared, which is that this technology found a way around them. And I think it's, like it or not, for the regulators, the choice that they've made, which is now apparently pretty locked in, is to shove this into the shadows and the engineers are going to find a way around them again. I'm confident.
Well, my hope for the future is hopefully there'll be synergy between policymakers, the engineers, and the financial system, and we'll have this beautiful product at the end of all of this. What an energizing conversation. I want to thank our guests for being here today. Sean, Caitlin, Guy, thank you so much. And now back to you, Dan.
Thanks, Layla, Caitlin, Sean, and Guy. Appreciate you sharing your thoughts on the challenges and positive contributions digital assets offer society and the wider financial system. And thank you all for watching. Remember, please, to take our survey at any time during the event, just click the link at the bottom of the page. And if you're sharing your thoughts on social media, please use the hashtag #InsiderEvents. We all know tech can solve many problems and even prevent them, so let's take a closer look at the payments world with our next session discussing if the future of payments is going to be frictionless. Please welcome Carter Johnson, Senior Finance Reporter here at Insider, and his guests.
Thanks so much, Dan. Really appreciate it. It's so great to be with you all. I think we can all agree the past few weeks have shown just how quickly information travels across the financial markets these days. Recent market events have also underscored the importance of money movement across every aspect of our banking system. And stepping back, new technologies, new payments technologies, from real-time transactions to digital currencies, have quickly moved from theoretical ideas to very real features and products. So I'm wondering, what does the future of payments look like? And what does friction really mean when it comes to the ways in which consumers and businesses transact? I'm really excited to be exploring these questions with three leaders in payments and banking. With me today are Jackie Reeses, the CEO of Lead Bank and former head of Square Capital. Hey, Jackie. Soups Ranjan.
Hello.
The co-founder and CEO of Sardine. Hey, Soups. And Sarit Amir, Innovation in Emerging Tech for Payments Lead at JP Morgan. Hey, Sarit.
Good morning.
Thanks so much for being here with us today, and I'm just kind of game to get right into it. We've got 20 minutes, and we've got a lot of ground to cover. So the first question I want to pose to you all first is thinking about the angle, the theme of this panel. It's the future of payments will be frictionless. But I think within that, there's a lot to explore. So I'm curious if each of you could tell us a little bit about where you actually do see friction showing up in the payments world, in your payments worlds, and relatedly, where can friction actually be a good thing, maybe a necessary thing, when we're talking about payments across infrastructure, fraud, merchants, et cetera. So Soups, why don't you take that one first?
Yeah, no, absolutely. I think friction is important when it comes to payments, especially when it can actually stop fraud, right? So we like to say that you should think about friction from the point of view of the context that you are in. So, for example, whenever I'm logging into any of the banks or the fintech apps or the crypto apps that I deal with, I always want to be reminded that I have a 2FA. So I want as much friction as possible, right? And in particular, when I'm sending money out, I always want that friction from a second factor authentication, right? Or, like if I'm signing in or logging in from a brand new device, I want to be challenged every single time, right? Because here's the deal with making high dollar value payments completely frictionless is that, then you completely forget about the existence of these second and the third factors. And that's what scammers can actually take advantage of, right? Because if somebody didn't challenge me with a 2FA, what is going on at the back of my mind is, hey, did somebody take over my phone number, right? Or did somebody take over my my banking app and removed all those 2FA factors, et cetera, right?
Sure. I think that's a great point. And Jackie, I know we've spoken about this a little bit before too. So I'm curious, where can friction be a good thing?
Well, I think that was a perfect start to the conversation because in many cases, friction can be a benefit. And if I think about what it does, friction really limits you from having a real-time transaction going through. And so there are many cases in financial applications where that's helpful. And so you could see that around identity, you could see it around fraud. And so those things are really helpful in order to create an experience that you would hope from end to end for both businesses and consumers to make sure that the right group of people is actually doing the right transaction. And so I would think of it as a feature, not a bug in some cases. I do think there are issues around B2B infrastructure, around companies that are trying to embed financial products into their applications, where you want that experience to be end to end smooth. And so there are places, just from an infrastructure point of view and the way the banking system works today, where friction between a front end application and the back end infrastructure provider, which could be a bank, it could be some kind of financial institution that holds your account structure, it could be a company that manages your financials in some way, like tax software, accounting software. And you want that evolution of the customer experience to be incredible. And I think that's where friction today is still complicated within the banking and payment system, and is hopefully going to get abstracted out in the next 10 years. I'd say like the last 10 years have been amazing to kind of take out some of that pain from consumer experience to banking experience, but then going one level deeper in a P&L for companies has not been abstracted away, meaning the infrastructure that gets you all the way through that financial transaction, kind of at that core money movement level between B2B companies.
Sure. I think that's a great point. And, I mean, I think we could talk for days about kind of some of the core questions, the infrastructure questions. But Sarit, I do feel like that's a good segue to you, obviously being at JP Morgan and working with, I imagine, a lot of merchants, a lot of businesses. So I'm curious, just from your seat where you are, again, where can friction kind of within a lot of those processes be a good thing and be something that actually is kind of additive to your process?
Great being here, and I agree with my co-panelists, right? We want to prevent fraud, but we also live in a day of instant gratification and on demand. So we want to make sure that we can address real-time payments, because there's just consumer expectation around that. So I would think that over the years, real-time payments will become more real, because if you think about it, 10 years ago, if you wanted to hand someone money in London from New York, you'd have to get on a plane and fly over to London to hand it yourself. But today, sometimes we're talking about what is real time, and we find that we're talking about, is it seconds? Is it 5 seconds? Is it a minute? And so this is where you do want to introduce some friction, because if I am paying Jackie, you want to make sure that I am who I say I am, and Jackie is who she says she is, because as technology is addressing fraud more and more, technology is also giving the hackers and the bad players more tools to achieve their agenda. So I think it's balancing to consumers' expectations, but also protecting them.
Sure. Yeah, I think that makes so much sense. And if I can keep it going, one of the things we've all been looking at over the past few weeks, and certainly it's been taking up a lot of my time, has been, we've seen the collapse of Silicon Valley Bank, we've seen the sale of Credit Suisse. It's been a total whirlwind for a few weeks for banking broadly. And it's kind of clear now, especially within the past few weeks, that if folks are looking at fintechs, they're also looking at the banks standing behind those fintechs. And again, within a payments context, I'm curious, how should the choice of bank or financial partners shape how companies think about payments innovation? And Sarit, I know JP Morgan is a friend to many startups and is obviously active in the space. So do you want to take this one first?
Sure. So, I think that SVB clearly created a platform to help entrepreneurs and startups, and really if you think about it, from the idea itself all the way to scaling a company, and that was a unique value proposition. And I'm sure that's very difficult for a lot of entrepreneurs and startups. But the large financial institutions, even though we're focused on stability and strength, we also very much care for innovation and supporting the innovation ecosystem. So I would just think that entrepreneurs moving forward are going to have to find that sort of balance, solving for their clients' problems in the best way. And obviously they take calculated risks, but finding financial institutions and financial partners who are going to support them on that journey, but at the same time, maintain that stability, right? Really bring forth the risk and control aspect to make sure we're all safeguarding the financial sector.
Sure. Yeah, I think that's a great point. Jackie, I feel like you have some thoughts here. You want to jump in?
Yeah. it's been fascinating to run a small bank in this environment located in Kansas City. And interestingly, the experience in Kansas City around deposits feels very different than that around the coast. And we did not lose $1 of deposits from our local community. In fact, we added significantly from a broader set of companies that needed real-time onboarding into the banking system post SVB. And so that's been an interesting advantage of sitting in Kansas City with an actual FDIC insured bank. I think there's two sets of needs primarily that I saw come out of this for companies. One was basic corporate services around account setup, checking, savings, balances, money movement, sweeps. And coming out of this, what I saw is companies are now making multiple bets across banking partners that they want to pursue. I think that's the right strategy. I would go find a bank that is either uncorrelated on a regional basis to what we saw, or a systemically important bank, and also someone who might be able to help you on a more transactional level day to day if you want a more personalized experience from someone who's smaller, or even like a tech company that's like an abstraction layer. I think having multiple parties like that can be very helpful to companies where before they might have had all their eggs in one basket. The second set of services I've seen companies need is around fintech infrastructure and companies associated with lending, issuing, acquiring, and finding bank partners to help them bridge into the financial services system because of the products they want to build. And in that regard, I have seen, and it's frankly happened for the last 6 months, an evolution and focus on who is your underlying bank partner. And do you have a quality partner that can help you scale? It's one thing to sign up with a bank partner that helps you just start your company at a really small level. But once someone starts to scale, they need to pay far more attention to who that partner is, how successful they are in working with regulators, what kind of quality clients do they have, and make sure they're dealing with partners who they believe themselves are of the highest level of integrity, the highest level of quality of partner, and someone who can work with them in an agile and creative way. And so we've seen an incredible opportunity coming out of the last 6 months with crises happening at lots of different banks that operate within both the crypto field as well as the fintech field, where bank partners have not been able to meet the regulatory requirements needed in order to help scaling in large fintechs at the level of compliance, controls, agility, success that is needed in order to be a partner that operates within the banking system. And so I think now more than ever, that is really important. Quality matters, integrity matters, compliance matters. And I think, folks have had their eyes opened into how to be more creative and thoughtful and looking for partners like that.
Sure. I think that's really helpful. And, it makes me think, too, Soups, I want to make sure you kind of get a chance to answer this as well. Within fraud and within payments fraud specifically, I'm just curious, I'm as Jackie said, kind of a certainly interesting past few 6 months, few weeks, et cetera. But how have you seen that kind of question of partner change over time? Just curious if you have anything to add.
Yeah, no, absolutely. So it's not just fraud, but fraud and compliance. So one of the key observations I've had over the last several months is, if you are a fintech entrepreneur and you're looking to start a new fintech program, you should do due diligence on the banking partners that you want to work with to really, align with what are the onboarding requirements. What does a customer CIP program look like, right? And then also build an understanding, a common understanding around, whenever, who actually owns the KYC in the CIP. What should the KYC anti-money laundering or the KYC ML policies and procedures really look like? And furthermore, there is still some lack of full clarity on where does that ownership actually set the KYC ownership between the banking as a service platform and the fintech, right? So we are also seeing, some new innovation happening with my company also, Sardine, being involved in this, where we are saying that let's have a common shared platform across all these three participants, the bank, the BaaS platform, and the fintech, so that whenever you need to actually escalate a customer review, you're not really sharing PII information over emails, right? Because that just leads to its own set of problems. Those RFIs or the request for information should really be shared within one common dashboard, one common single pane of glass view across all the participants, right? So one thing I'm really bullish on is that in the near future we will have much better technologies, which is going to align all the different participants in this ecosystem.
Got it. That's really helpful. And we could go on, I know, for many, many, many hours, and there were other questions I wanted to ask you, but in order to keep it moving, I wanted to, as a last question, ask each of you, thinking really big picture, really kind of zooming out, kind of going wild, to close out, what do you think is one defining trend that might or will shape the future of digital payments in the coming years? So again, feel free to give us something surprising, something bold, even a prediction for 10 years out. But I think it's just, a good way to kind of think about the future. Jackie, I feel like you've got something good here, so why don't you kick us off?
Sure. In any platform shift, you see technologies leapfrogging one another. And I think we've just gone through that because of COVID. And we are living in a far more mobile banking system than ever before. And what I would see is further penetration of software being deployed in order to move money agilely. And I say that meaning away from devices that might have hardware attached, where, in prior cases, you might, companies might not have felt comfortable with IDV or fraud happening on any device because you can't control, what screen scraping technology shows up on a mobile device. And so the idea that you can now use a mobile payment device for any type of payment transaction, I think will only take footing and then amplify over the course of the next 10 years. So what do I think that means? I think it means that where we started with money being digital only amplifies, and money movement around the world such that borderless commerce can take place for both supplies and people in a way that becomes where friction is far reduced from what it is today, I think will only be amplified. And I don't think that has to happen in a crypto-only world. I think the evolution of how money moves amongst regulated institutions will also completely change as FedNow gets introduced in July of this year, where 24/7, 365 payments can take place. Once a system like FedNow is connected to the SWIFT system, I think we'll really see changes in how some of these international transactions take place. And that's usually the place where you have the absolute worst experience in trying to send money anywhere around the world in an easy way. And if anything happened in COVID, it's that people and suppliers became global. I think that will not be put back in the bottle where we start to have, very localized networks anymore. Companies are interacting everywhere around the globe, and we need our payment system to catch up to that. And so that's what I see being the biggest change over the next 10 years.
Sure. I think that's great. In order to keep it moving, Sarit, and this can be certainly your view, this can be JP Morgan's view, but I'm just curious, what do you think?
Sure, and I apologize, I'm not going to be that bold. I'm going to build a little bit on what Jackie was just talking about, which is digital wallets will gain more traction, not necessarily in the consumer space, but more in the B2B space, because this has not been an area of focus to date. And to what Jackie is saying, global commerce is becoming more and more a reality for all of us, right? It got accelerated during the time of COVID, but now it's just here to stay. And when you're thinking about B2B and the digital wallets and real-time payments, you have to incorporate the nuances of cross-border, and that makes it even more challenging. So I'm really fascinated by how this will evolve, and I do believe that we'll see the intersection of digital wallets and real-time payments really in the B2B space taking a leap forward.
Sure. Yeah. Thank you. And Soups, to close us out, something related, something else? What do you think?
Yeah, one thing I'm really fascinated by is that, first and foremost, we have this saying at Sardine that with faster payment methods, you get faster ways of losing money or faster fraud, right? So with the rise of, newer, faster ways of moving money, with FedNow coming to the fore, and as we've already seen with Zelle, Square Cash, et cetera, right? We are nowadays, carrying our complete digital lives and all our banking and financial apps in our pockets, right? And I'll give you one example. A couple of weeks ago, there was this article where somebody noticed a Monzo app user in the UK. They noticed the PIN code that they were typing on the phone, and then they stole the backpack. And now guess what, right? Like if I know the PIN code in your phone, how many of you have 2 of you on your email or 2 of you on your SMS? No one does, right? It doesn't exist. So once you are in someone's phone, you actually are in the banks, you are in the fintech apps, you are in the crypto apps. And lo and behold, that individual lost all the money from all their accounts, right? So where I'm going with this is that, we need to now start thinking about protecting users' money, which is really in their phones in a digital wallet, right? From very different ways, right? You need to now start thinking about if I'm at a bar and Jackie picked up my phone, the way she's going to interact with the JP Morgan Chase app is going to be very different than I interact, right? Because we all hold the phones actually very differently. So we are actually very bullish on use of biometrics. That's what Sardine does. How you hold the phone, how you type, swipe, in fact, how you walk. All these intrinsic behavior technologies will be very paramount to stopping fraud in the real-time payments world.
Sure. And that is definitely going to make me more careful about who I open my banking apps in front of, but it's a good point. I think that's pretty much all the time we have, but I really want to thank you all for listening. Sarit, Jackie, Soups, for being here today, for taking the time, sharing your knowledge with us. This was a super engaging conversation. And to me, it sounds like banks, payments players, fintechs, customers, we all alike have kind of good reason to question what, quote, friction really means when it comes to payments. So again, thank you all for taking the time. Back to you, Dan.
Yeah, thanks so much, Carter, and thank you, Sarit, Jackie, and Soups for sharing your insights. And now for our final session, please welcome Insider Senior Finance Reporter Rebecca Ungarino and her panelists for a conversation about how to navigate the ESG landscape. Over to you, Rebecca.
Thank you so much, Dan. It's been a tough run for ESG-minded investors, that is, those who take environmental, social, and governance factors into consideration. The wider market, of course, is coming off of its worst year since 2008 with widespread turmoil, and ESG funds were no exception. Meanwhile, regulators are cracking down on greenwashing, and lawmakers are criticizing sustainable investment strategies and spreading some misinformation about ESG in the process. So how are leaders in ESG and sustainability navigating pretty difficult environment, and what are lessons learned from a challenging run? I'm thrilled to be here with 2 of those leaders, Nikita Singhal, co-head of Sustainable Investment and ESG at Lazard Asset Management, and Aniket Shah, global head of ESG and Sustainable Finance at Jefferies. Thank you both for being here. It's been, a tough run for ESG in some sense, from a reputational standpoint, I think, from some of the backlash that we're seeing in the public. You have different roles, you're both in the same world. I'm curious how you're navigating against this backdrop. Aniket, I'd love to start with you on that.
Yeah, it's a really exciting time to be in this space because everyone's trying to figure it out. We are trying to figure out what ESG is all about. We're trying to figure out what the climate topic's all about. And there's more energy, enthusiasm, excitement, and questions around it than ever before. And we think that's a pretty good thing. Our general thesis, though, is that there's actually a lot more agreement and consensus around ESG and climate today than there ever has been before. Investors that we speak to get it. Climate change and how policymakers are reacting to climate, how business leaders are reacting to climate, how technology is reacting to climate. is impacting asset prices, so I should probably be looking at it. They get it that how businesses respond to different trends in the labor market will impact asset prices. So we don't actually see that much disagreement on the underlying issues. The terminology is creating a lot of issues for the space, and the definitions are. But I think over today's discussion, we're going to talk about where there is agreement and where there is disagreement. But I think there's actually a lot more agreement on the underlying issues in the capital markets than what meets the eye.
Absolutely. Nikita, I'm curious what you have to add to that.
Yeah, I completely agree. I think it's going through a healthy reckoning. An industry colleague of mine refers to it as going through its teenage growth spurt. And it is still a bit of an alphabet soup when you think about the world of ESG. There are terms like SRI, or socially responsible investing, impact investing, there's faith-based investing, and I think there's a healthy detangling that now needs to happen about what is ESG and what it isn't. Some of this I understand, because when you think about the forefathers of ESG, like faith-based investing, SRI, go all the way back to several decades, if not centuries. The Methodist movement dating back to the 1700s. Then you had the apartheid movement, the Vietnam War. All of these started to influence how individuals express their values through their investing. Cut to the latest iteration, ESG, I would argue is very different. I define ESG as discovering and pricing environmental, social governance risks and opportunities. And in that iteration, therefore, it is still very nascent. It's not something that has been around for decades. I would almost kind of liken it to where we were in financial markets pre-SEC, pre-FASB. We didn't have accounting standards. We didn't have benchmarking techniques. If you said EBIT for the same company, I would perhaps come up with a very different number. So these frameworks, even frameworks in terms of academic concepts, like a Miller-Modigliani equivalent of optimal capital structure, we don't have those in ESG. There are some amazing academics who are currently working on really interesting frameworks, but my point being it's still very nascent, so it's understandable that there is a lot of confusion and conflation in the marketplace today, and it's healthy for us to have these debates. I would end kind of with the point that Aniket was making, which is that the underlying trends, regardless of what we call this, whether it's trying to understand the risks and opportunities in the energy transition, issues like worker livelihoods and how companies are on the risk and opportunity spectrum when it comes to issues like that, or changes in consumer habits like healthier living. These are impacting products and operations of companies regardless of what we call it, and therefore impacting those companies' financial productivity and their valuation. So as investors, we are deploying ESG not as a mechanism to impose our values on companies. I don't think that's appropriate as fiduciaries, and you and I as individuals who might have very high morals might disagree on what's more important than another. Sure. But what we can do is, as disciplined investors, find ways, figure out catalysts to price in these issues. And that's our job as investors that do ESG right.
Absolutely, and it's a great parallel to kind of like pre-SEC in the markets. Like, I'm so glad you said that, because it is kind of like, as you think about where we are in ESG, I think that's a totally apt, kind of parallel. And I do want to talk about the nomenclature a little bit, as how we talk about ESG from kind of sector to sector. And I would love to kind of drill on, into that more, Nikita. How do you think about ESG from sector to sector? Maybe a technology investor is going to have other, rather than going to have different priorities than, say, an energy investor. So I'm curious how you think about ESG issues from sector to sector.
Yeah, ESG is not monolithic, right? So the issues that pertain to a particular company might be very different than the issues that pertain to another company. This might be because of the sector they're in. So if you're a healthcare company in the US, you might be grappling with issues like the safety of your products. Inherently products that are ingested or implanted in the body are going to have product liability concerns. You might have to grapple with issues like access and affordability if you're in the pharmaceutical space, and you see that with net pricing related regulation in the industry. But if you're in the tech sector, you're grappling with a very different set of environmental or social challenges. You have to worry about things like data privacy, and we saw this with the Cambridge Analytica scandal. You might have to deal with issues like responsible content, where the significant societal backlash to social media might create inherent regulatory challenges for companies in that space, and across the board in China as well as in the U.S. as we're keeping track today. And you might have to deal with issues like carbon emissions from your data centers that are significant drivers of, energy is a huge part of the cost base for its data centers, which are a huge cost for these technology companies. So as you can see, ESG is very contextual, or I should say the financial materiality of ESG is very contextual. And what I would argue today is to be able to do that well, you can't approach it in that monolithic way where you have 10 ESG metrics that you look across an entire portfolio and call certain companies good or bad. It's much more nuanced and bottom up. And as a fundamental active investor, which is what we are at Lazard Asset Management, we're most focused on doing that. Decoupling these thorny topics and thinking about what are the catalysts that are going to price that into the financial productivity or the valuation of the company.
Yeah. And Annika, what about you when you're talking to clients and you're kind of thinking kind of sector by sector? What are the kind of questions that are dominating, your kind of questions, and how do you think about that across sectors?
It really changes by the day.
Yeah.
It changes by the client, and it changes by the geography.
That's why it's so exciting.
It is
to be
very
you.
exciting. It's a lot of fun. It really is
Right.
it's hard to imagine you get paid to do work like this. It's really good fun. But there are some topics that are cross-cutting, for sure. The G of ESG, which oftentimes gets forgotten, is a cross-cutting topic because it's ultimately a question of how are decisions made and who controls a company. That's relevant in a tech company, that's relevant in a consumer goods company, it's relevant in the US, and it's relevant in China. Now, what makes a well-governed company in the tech sector might be very different than in the consumer sector. And there's a lot of judgment that goes into that. But I would say governance is a cross-cutting issue that any good investor or CEO or investment banker knows I need to be thinking about. On the sector by sector work, Nikita is absolutely right. I'll give you just some live examples of what's on our mind.
Please.
We spent this morning talking to one of the largest active managers in the world, going really deep on what the Inflation Reduction Act means for energy transition in the United States and how Europe is responding to between $500 billion and $1 trillion of subsidization and public investment in the energy transition. On the other side of the table wasn't the ESG team at this firm. It was the energy investors, it was the industrials, it was utilities, it was folks who were managing hundreds of billions of dollars of capital, going into the details of this tax credit versus that tax credit and what it would mean for different companies that they invest in. Early this afternoon, the conversation switched completely, talking to a very large credit investor. And they were really interested in this topic of human capital, which we spend a lot of time writing about. And specifically, what do we know about layoffs and the impact of layoffs on the long-term profitability and therefore the credit risk associated with companies that they invest in. They are predominantly in the tech space. We then spent, right before coming here, a little bit of time talking to some clients late in Europe, and they were talking about deforestation and all these European rules that are coming into place in the EU around deforestation laws that will impact where they can get imports from and whether that makes investments in emerging markets, including in Brazil, less attractive. So sector by sector, geography by geography, and type of investor, equity versus credit versus private equity, all impacts the conversation. But Nikita said it right. This is about pricing risks and opportunities that arguably investors should always have been pricing. The thing that has changed, at least the way we think about it, is that the materiality of these topics has increased. And you say, Annika, how environment was always important. I would say, yeah, but we only got the Paris Climate Agreement 8 years ago. And now 90% of the world's emissions are under a net zero framing. So yeah, maybe climate was important 10, 20 years ago, but now policy and technology is moving. So these things are becoming more important. They're becoming driven by policy and technology, and capital markets are responding.
Yeah. And Nikita, I'm curious, like as you think about catalysts going forward, whether that's on the regulatory side, whether it's on how consumer tastes are shifting, what are the next catalysts, if you will, that you're looking toward for 2023 and beyond that investors should know about?
Yeah, I couldn't have said it better than Aniket. You know, I think that when as investors, what you're most focused on is how can you have, as fundamental investors, you know, and active investors, how do you have a view that's different from market consensus? Mm-hmm. And it's extremely hard in markets like the US that are incredibly efficient. Mm-hmm. Things get priced in very quickly. So it's an incredibly exciting time for active fundamental investors because the market does not have a consensus around a lot of these issues. We don't know how to, we don't have the same views on when they're going to get priced in what magnitude, and whether they hit companies' cash flows or balance sheets. There's a lot of debate, and that makes it, in what I would argue, the greatest alpha generation opportunity of our time. As he said, these issues have always existed in the past. What's happened now is we are seeing the structural shift towards many sustainability trends. And it might start with, you know, individual values, but it's starting to shape normative values that then forces these catalysts to come into play. So to answer your question, the way we often think about it is three major catalysts: regulation, and you know, Aniket touched on the Inflation Reduction Act, the EU's policy response to that, and many policies around the world. Not just at a government, you know, high policy level, but even at an industry level, the things like building emissions codes that might impact the opportunity set for LED lighting companies and shift initially their multiples, eventually their financial productivity, because it impacts their revenue and their market share. There's regulation, there's shifts in consumer behavior, where you're seeing consumers voting with their wallet in terms of things that they care about. Everything from you know, what their packaging should be like, that may not impact the valuation of a Coca-Cola or a large, you know, CPG company, but it is certainly, we are starting to see it impact the valuations of packaging companies down the supply chain. So the knock-on effects are important to observe, not just the immediate, you know, companies that are impacted or in front of us. And the third and perhaps most important catalyst is technological disruptions. When we think about electric vehicles, renewable energy, or LED lighting, the example I just gave, maybe 3 to 5% of the ACWI index today has pure play companies in that space. I'm talking about, you know, the Teslas, the Vestases of the world. But when you actually look at the knock-on effects of their supply chain, everything from silicon carbide to graphite to the battery manufacturers to solar inverters, it has more than a 25% impact on the ACWI index. So there are tremendous opportunities, and these technological disruptions and breakthroughs are going to create disruptions in their respective industries, creating significant opportunities for us as investors.
And Aniket, do you have anything to add to that? I mean, those are so far-reaching and make a lot of sense. Anything that you would like to add?
In my life, I've learned listen to Nikita because she generally gets it right. So I think that's perfectly said.
I'm like, I don't think there's much to add there. I want to end on a kind of actionable takeaway for our viewers. I'm curious what you are most optimistic about in this space right now. There's a lot going on the regulatory side. I'm curious how you would answer that, Aniket. What are you most excited about?
The topic that we are going very deep in right now is carbon removal and the role of carbon markets in carbon removal. When we think about climate change, we should think about three legs of the stool. There's mitigation, which is how do you reduce CO2 emissions. There's adaptation, which is how do you adapt to a warming world. And then there's removal, which is actually how do you remove excess CO2 from the atmosphere. And that third leg of the stool hasn't been getting a lot of attention, but there are technological breakthroughs happening every day in direct air capture and nature-based solutions and so on that are coming to life because of technology and policy. It's one of these beautiful things. The Inflation Reduction Act puts a price on this. Companies say, wow, I'm going to get paid $180 a ton to remove a ton of CO2 and stick it underground. That actually makes a lot of things quite economic. So we're spending a lot of time studying this third stool the third leg of the climate stool after having spent a lot of time on the mitigation and the adaptation front. And we're seeing entire industries being formed right in front of our eyes. It's very, very exciting and something we're going to spend a lot of time on.
That's great. And Nikita, how would you respond?
So I would maybe zoom back out and say more broadly what I'm really excited is about this current debate on ESG, because I think it helps clarify what it is and what it's not. It's not there trying to prove that we can save the world, and it's not something that's projecting individuals' personal values or biases. It's just making us disciplined investors, and I think that's a really healthy debate, as we've suggested. So that I'm excited about that conversation, that it's finally happening, and there are many of us pragmatists in this space that are helping clarify that. And on the other end, what I'm actually really excited about, and Aniket and I were talking about this last time when we met for lunch, was it doesn't matter outside of this rhetoric in the marketplace. Taking something like carbon emissions, the carbon emissions are a result of tens of thousands of businesses and their thousands of business decisions that they're making every day on how to manufacture a product, what kind of product to manufacture, and how to get that product to a consumer. And as they start to shift those decisions subtly in terms of we want healthier product, we want products that are safer, we want products that are lower in carbon, those shifts are all underway around the world, and that creates pretty dynamic shifts in the industries that they are part of, and it makes us a really exciting place for us as investors. So I think that's the note I would probably end on.
That's great. And we do have some more time, and I would love to get in a couple more questions here, really about the supply chain. I'm curious, and you brought it up a little bit, Nikita. I'm curious, as our clients kind of focusing on the supply chain a little bit more, how do you think about the way you analyze that when it comes to how you think of it through an ESG lens? Can you speak to that a little bit across sectors?
Yeah, it's the devil's always in the details, but what I will say, it really comes down to materiality.
Yeah.
Right. So how material is a particular issue to yours? How material is a particular element of the supply chain to the broader business? And going back to very simple analysis of Porter's 5 forces, what is the relative strength of the supply chain relative to you as a manufacturer or as a producer of the goods? So I think it's very specific. It depends on the region as well. One of the things our analysts really focus on is if there are certain risks that are created in the supply chain, whether it's raw material related or human capital related, how can those risks be mitigated? And what are the conversations we need to have with companies to understand how material those risks are likely to be? So that's an important part of the conversation.
And it's very, behind the scenes, by very nature of it, I guess it is the supply chain. Maybe it's not always on top of the investors' minds. And again, I'm curious how you think about that.
Yeah, I'll add a different perspective, which is the top-down geopolitics and its impact on supply chains. We're seeing right now a rewiring of the global economy geographically. The US-China tensions are at all-time highs. The US-Russia conflict is at least near-term highs. And that has caused a lot of decisions being made by corporates around reshoring and friendshoring, which is impacting fundamentally how businesses operate. And it's one of these moments where I agree with Nikita very much that a lot of this is materiality driven, bottom up, sector by sector. And at the same time, there are top down sort of zeitgeist shifts, transformational things that are happening. And by the way, a lot of that is being driven by, in quotes, ESG considerations. Russia invading Ukraine, hundreds, thousands of businesses leaving Russia almost overnight, investors divesting Russia from their portfolios, at some level was a set of ethical decisions. They were saying we can't actually be involved in this part of the world anymore. Those questions are happening right now around China too, as conflicts between US and China increase, and US companies have huge supply chains across the Chinese economy. So it is absolutely top of mind. And again, it's one of these things where ESG as a set of externalities outside of what a business may be doing day to day, but can impact what they do. We're seeing this in live time on supply chain issues.
Yeah. I think it also, to one of the earlier points we made, was it's trying to understand how this starts to impact companies by looking at the catalysts, right? And the Inflation Reduction Act in some ways is, also responding to geopolitics, but it is reshaping how companies are thinking about their supply chain, including European companies thinking about setting up, more manufacturing and supply chain on this side of the Atlantic, as it might be beneficial. And that, I think, I would argue, has propelled the EU response more than anything else. So I think it is, to go back to why our jobs are so interesting, because it is beyond even just the ESG rubric that we talk of. It's contextualizing geopolitics, which has greatly kind of shaped this discussion, and other issues like COVID as well. Right?
No doubt. Yeah. This is terrific. I really want to thank you both for being here today. One takeaway, I think it sounds like for our viewers, is that investors should be looking at maybe policy, a little bit more than they have been in the past, and that, as you said, Annika, might be more agreement among investors than some might think when it comes to ESG. So I thank you both for being here today with us. And Dan, I will toss it back to you.
Thanks, Rebecca, Nikita, and Aniket, for such an insightful conversation. And thanks again to all our panelists and speakers. The discussion doesn't have to end here. These are topics we will continue to cover at Insider in a variety of ways. So be sure to subscribe to our daily newsletter, 10 Things on Wall Street, to stay up to date on all the current financial news. And please remember to share your thoughts using the hashtag InsiderEvents. In a few moments, our survey will pop up on your screen. I'm Dan DiFrancesco. Thank you all for joining.